I am Dolph Janis. Welcome to part two of Biden's proposed tax plan. We did a webinar a couple of weeks ago on his original, and this is his latest proposed tax plan I'd like to be able to share with everybody today. So thank you everyone for joining us. Also, you'll notice on the right side of the screen, there is a button to get our handouts for you or any chat buttons along with it. If you have any questions, I'll answer them afterwards. But we also have a handout of a full list of all the proposed tax plans as well as other resources we'd like to share from you. Again, this is not a webinar about politics. It's a political webinar. This is just a proposal, a starting point about what the current administration is looking to do. It's impossible to know what changes will make it through this legislative process and ultimately become law. Use of this information is to initiate discussions, not to make final decisions or recommendations. Again, this is all the information that he is saying he would like to get through for his tax plan purposes going forward. Now, been in the industry for almost 17 years now, and I always like to start my webinars and how it began. And I'm gonna really quickly, just like I said, I used to be a dealer, casino dealer, and a pit boss out in Reno, Nevada, and Las Vegas, and it was a lot of fun. And I met a lot of people out there. And I just want to share a short story with you of where my mindset became to go about winning and losing, and risk versus reward is never gamble with what you can't afford to lose. And that was one of the things that I really stuck in my mind about being out there. And I met a lot of friends out there. And Brandon Thomas is, I'll knock him down, as one of the best friends I met out there. But he was a pretty good gambler. He was a local out there. And I'll never forget how many times he lost. And he would lose on the craps table and lose on the blackjack table, and he didn't get any write-offs. And then one day he ventured out into the slot machines, and he just lost several $1,000s at the tables, and he hit a very nice jackpot, about $8,000-$10,000 jackpot on the video poker machines, and he got a 1099 for it. And he was like, well, why did I get a 1099 for winning, but I didn't get one for losing? And it was just, it didn't make a lot of sense. It's like, well, it's the way that the system works, unfortunately. And the system that we live in is risk versus reward. And I'm not one of those type of players. I'm more of the guarantees. And when I got in this industry shortly after leaving the great state of Nevada, I'm like, I want to go forward. I don't want to go backwards. And that's how I got into this industry. And Brandon's still a great friend of mine today. And glad to hear he's not gambling as much as he used to do in the past. Again, I'm an educator first and an advisor second. I've had a radio show for the past 11 years. I've been featured on Forbes and a lot of these other articles, which all can be seen on our website at clearincomeforlife.com. And all these articles were written by me, and I was featured in a lot of these articles. And please go through and share them with anybody you'd like to at the same time. Again, I'm an income strategist. I was the author of Cross the Bridge to Retirement about a year and a half ago. If you'd like to have a copy of that, either PDF or a hard copy, you can reply to the chat button on the side of the screen. We'd be more than happy to get that over to you. The first thing I'm going to do is I want to share a little video about the history of taxes. It's a little cartoon video, and it puts everything in a lot of perspective before digging into the nuts and bolts of this presentation. So it's about 3 minutes long. Sit back and enjoy it.
Taxes have been around in one form or another for thousands of years. The first known system of taxation goes all the way back to ancient Egypt in 3000 BC. Back then, the pharaoh would tour his kingdom every other year and collect 20% of everyone's crop harvest. And ancient Egyptians weren't very happy to pay taxes. Today, our modern tax system is much more complex. Because the government is continually tinkering with our tax system, the Internal Revenue Code is 6,550 pages long, and that doesn't include the 7.7 million words of tax regulations that are used to interpret those pages. There are generally 3 categories of tax treatment for your retirement savings. Taxable, where you pay taxes every year on your earnings. Tax deferred, meaning you don't pay taxes until you withdraw money. And tax-free, where you do not pay taxes on your earnings at distribution. Each category has different rules, different tax treatment, and different advantages and disadvantages. But all too often, many people have all their retirement savings in just 1 or maybe 2 categories. And when tax rates or rules change, you might be unable to make adjustments to your retirement income. Consider siblings Bill and Jill. Bill owns a traditional IRA. Jill owns a stock. When Bill takes money out of his traditional IRA, he must pay ordinary income taxes on the total amount he withdraws. Jill, on the other hand, when she sells her stock, will pay capital gains taxes on just the growth of the stock while she owned it. For Bill, his ordinary income tax rate can be as high as 37%, but for Jill, her long-term capital gain tax rate maxes out at 20%. Bill received a tax deduction in the year he contributed money into his traditional IRA. Meanwhile, Jill didn't receive any tax deductions when she bought her stock. Complicated, right? Now consider if Uncle Sam increased the tax rate on ordinary income, but left capital gains tax rates the same. Suddenly, Bill's taxes on his traditional IRA would go up, but Jill's taxes on the sale of her stock would remain the same. The result is that Bill would have fewer dollars in his pocket than Jill to pay his bills in retirement. That is why a retirement strategy that includes a strategy of tax allocation can be important. Much like you may use asset allocation to diversify your investments, tax allocation diversifies your retirement plan components into vehicles that are taxed differently. That way, should tax rates or rules change for one part of your retirement strategy, you could shift to using retirement funds from another area. Your financial professional can help you understand how various insurance products can help you achieve a tax allocation strategy and how different retirement savings vehicles can work together to benefit your income needs in retirement.
So I just wanted to share that little video with you about, but the one difference with the capital gains tax they didn't talk about is the loss policy, possibly with if it was in stocks and they did lose money on there. So there are a lot of strategies out there between the three buckets, and that's what diversification is all about. And that's why we run TaxMap software for all our prospects and all our clients, and getting them to know all the updated tax formats. I mean, $7.7 million of, or 7.7 million pages of interpretation leaves a lot to be guided, and you know it's going to change a lot over the next several years, because every administration, when they come in, they have different ideas on what they want to do with taxes. Under the Trump tax plan, you noticed that went passed through. That's sort of good through 2025. So there's a lot of low taxes right now, but that's what this presentation is about, showing you what the current administration is looking to do in several different categories. Now, the first category we're going to talk about is the personal income tax increases, which have been proposed on here. Again, if you have any questions on the right side of the screen, feel free. I've seen a couple have already pop in, and I appreciate those to go over for you. And also you can request any of the information that we have as well as a total layout of this whole presentation. In the current law and the new maximum tax rates, there's 7 different tax brackets going from 10% all the way to 37%. The proposed change has increased the highest bracket from 37 to almost 40%. And it's not clear if the current thresholds would stay the same, or if the 39.6 tax rate would begin at $400,000. They're still wiggling around right now on how to tax the people that have more money. Is one of the big proposals there. Capital gains, current laws, taxes on long-term capital gains and qualified dividend incomes are capped at 20%. If you go 23.8%, if you include the Medicare surcharge. The proposed change is tax a portion of the capital gains and dividend income over the 1 million mark at the highest rate of 39.6%. That's 43.4%, including Medicare surcharge. If this goes through, it'll be a huge change in the tax structure for a lot of people when it comes to capital gains and the way they look at capital gains. Payroll taxes has already started. As a business owner, I've already seen these. Employers and employees evenly split the Social Security payroll tax of 12.4% on income up to $142,800 in 2021. Proposed changes, in addition to the current law, taxable income above $400,000 at 12.4%. That's split evenly between the employer and the employee. Like I said, as a business owner, there has already been several payroll tax changes, and I can say we were paying a little bit more in taxes for employees and employers right now, unfortunately. Itemized deductions, that's another one that's the current law, is taxpayers can choose between the standard deduction on their tax return or itemize their deduction. Now, remind you, I'm not a CPA. We do have Raghi here in the office, who is a certified CPA for many, many years, a wonderful individual. He answers all these questions for my clients if it comes up, if they have questions on this stuff. But in the meantime, The proposed change to the itemized deductions is reinstate the piece limitations to reduce allowable itemized deductions when income is more than $400,000. Now you're going to really hear that number $400,000. You've already heard it 4 times today. You might be hearing it several more times throughout the webinar, because that seems to be the break threshold between the people that are really, there a lot of people that are going after right now is the people that have net worths of 400,000 or more. Then they want to capitalize the itemized deduction benefit at 28% for those incomes, again, over $400,000. Now, again, we have a spreadsheet. I know I'm going through this a little bit fast. I don't like to dwell on any certain little things for more than a few minutes here, but we do have a breakdown spreadsheet of all of this information on 4 pages. If you'd like to request that, just feel free to request it at any time. Another one is pre-tax qualified retirement plan contributions, like traditional IRAs, 401ks, etc. The current law, the size of the taxpayer's deduction is determined by their income bracket. The proposed change is reduced traditional deductibility with a refundable tax credit for contributions. Consumer benefit would be the same no matter what their income level is. For example, on IRAs, if you're over 50 years old, you can put in $6,500 a year to contribute towards your IRA program. Over 50 years old, you get $7,000. Under 50-year-old, excuse me, $6,500. That is depending on your income bracket. For instance, like a Roth IRA, if you make over $192,000 as a couple, you're no longer eligible to put money into that Roth IRA. The proposed changes on that is to stick with that, try to give you a refundable credit and contributions to put money in towards taxes as well. Again, hit your tax budget. It doesn't really help you out personally going forward in your retirement plan. 1031 exchanges, not very many people are familiar with out there. 1035 exchanges is tax-free exchanges for non-qualified plans. 1031 exchange, in some situations, this is all about real estate. Property can be sold and similar property purchased without creating a taxable event. That is the current law. The proposed change is sales resulting in a capital gain might be taxable to the individual, again, depending on your income level. Again, the CPA can answer that for you, because a lot of people would be doing selling houses, buy and sell. That's what they do for a living, and they wouldn't be creating taxable events with the gains. Now they're going to take those gains and make them taxable, potentially. Qualified business income deductions. Again, if you're a business owner, the current law is eligible self-employed and small business owners may deduct 20% of their qualified business income. Limitations apply, of course, but there's a great section in there where you can deduct your income on your taxes to help yourself out a little bit as a business owner. The proposed changes eliminate that deduction for higher income earners by adding additional phase outs. The phase outs have not been talked about, have not been mentioned yet. So unfortunately, I can't go into there, but once I do that, you can follow us on Facebook or any of our social media platforms, because we are in our monthly newsletter. Because once we get these informations, we do share them immediately for everybody, because again, we're educators first for you. Next section I want to tackle into is the estate planning tax increases that are being proposed out there for you right now. Again, it's going to affect some of you, not all of you, but it affects some of you, but it's good to know, because you might have a loved one that affects them versus affecting yourself. First one is estate and gift tax exemption. The current law, the estate and the gift tax exemption is 11.7 million, 23.5 million for a couple for 2021. The cap rates tax out are right around 40%. This is for a lot of high net worth, obviously individuals, but again, you'll see where the proposed changes is decrease the tax exemption amount to 3.5% or 3.5 million, 7 million per couple, and 1 million in lifetime gifts. And the tax rate for this is going to increase potentially to 45%, which means life insurance, estate planning, gifts that you're giving to your children, grandchildren, and so forth, used to be going up as a married couple of 23.5 million. With the exemption, now that's going to be shrunk all the way down to $7 million. So if your estate more of $7 million in gifts, boom, you're getting taxed. You're going to get taxed up to yin yang, and an increase of maybe up to 45% of that gift. Step up in basis. This is one that most people don't understand how it works. I mean, your CPA and financial advisors, we can explain it to you in detail in meetings, but in simple layman's terms, in the current law, At death, beneficiaries can receive a step up in cost basis equal to the value on many non-retirement assets. Where the proposed change would be eliminate the stepped up cost basis on all tax gains. It is unclear right now whether the gains will be taxable immediately upon death or the beneficiary decides to choose that asset. Now, there's a very broad speculation of what a non-retirement asset is. Everybody's situation is going to look at this different. Encourage you to go on the internet right now or at some point and find out what a non-retirement asset is. Or if you'd like a full list, once again, just ask us and we'd be more than happy to send you the current list that we have of non-retirement assets. Some of them are quite comical, but some of them are very serious and everybody actually has them. Personal income tax reductions on your personal one. This is one that a lot of people were interested in this webinar about because it comes down to personal. You and I, you and the spouse, and what reductions are we going to get? Are they going to be good? Are they going to be bad? Let's find out. A lot of us have children out there, and the children's tax credit for age of children's on December 31st of that tax year. Very important of the tax year that currently the age of the child is, no matter when they're born, it's when it is of that tax year. The current tax credit, the CTC for ages 16 and younger, is $2,000. $1,400 of that is refundable. A proposed change, they want to increase the CDC from $2,000 to $3,000 for children 17 and younger, and an additional $600 bonus for children 5 and younger. These benefits will be fully refundable. This is a good thing. One of the few reductions out there for CDCs and tax credits. So if you have kids out there, make sure your CPA or make sure when you're filing your taxes yourself, you're getting this tax credit. Because this is actually a thing that a lot of people don't use currently, and it's out there for you. The child independent care tax credit. I'm not good at initials sometimes, but the CDCTC is a non-refundable tax credit up to $3,000 per child or dependent, $6,000 family max for out-of-pocket children child care expenses. Now, this is where the line gets very thin, is what is a child care expense? Where the proposed changes expand credit to a maximum of $8,000 per child, 16 per family, and increase refundability up to 50%. There's a lot of wiggle room to be which way to do here. I like the proposed change of giving more up to per family as a maximum, instead of saying here's your maximum for family. 16,000 is a lot, and if you have child care expenses, they can be expensive. But paying a babysitter to come by every day and stuff like that, they won't look at that as a child care expense. Putting a kid into a summer camp, taking them to daycare, those things, those would be considered childhood expenses. Again, ask your CPA about that. Ask us. We'd be more than happy to give you that current list of what qualifies and does not qualify for them. A lot of us are home excuse me. A lot of us are home buyers. A lot of us already have our first home, but little one here, there's a first time home buyer tax credit. Right now, there's no credit available as the current law. The proposed changes offer a credit up to $15,000, capped at 10% of the purchase price. This benefit would be refundable and advanceable up front. This is basically encouraging people to buy their first home, which is good. That's a good thing. Next one we're going to be going into is corporate income tax increase. Again, this doesn't affect a lot of people, but it's good information to know going the road. And the current law for corporate income taxes, the Tax Cuts and Jobs Act reduced the corporate tax rates from 35 to 21%. I've seen that. It's been very helpful for me and any other small businesses, especially through the COVID area. But that's a great thing. But what they're looking to do is now increase that tax rate for businesses from 21 to 28%. And the Biden tax plan also includes other minimum tax requirements for corporations. Now you might say, well, this might not affect me as a human being because I don't own my own business. I'm involved in a corporation, so don't know how is this going to affect me. Well, as you've probably noticed over the past year, because we're almost coming up to over the 1 year anniversary of this COVID-19 virus, or whatever we want to call it, shutdown, or however we want to word it. But it's created this sense of urgency of we've seen a lot of businesses fall. And because they can't stay open because of the limitations out there, if this tax rate goes through for corporate registrations, It could cause more people to cause down, which could raise gas prices because transportation costs are more expensive going forward. So this is something to keep an eye on for the state of the economy and Wall Street itself. Again, this was a webinar. I told you it wasn't going to be a long one because we just like to go right into the bullet points of what it is, but it's not a political webinar. Again, this is just a proposal, a starting point, and it's impossible to know what changes will make it through the legislative process and ultimately become law. These decisions and what we talked about today, there's a heck of a lot more out there. We just attacked 16 or 17 of the ones we personally felt could affect you as a couple, affect you as a family, as a small business, and the total economy going forward. What we offer is a complimentary tax map program for you. This is a report based on your personal situation. It takes all the tax rules into effect for federal, not state, federal only. And this is a complimentary thing you can sign up for. You can call or text us at the number of 704-307-0202 or give us an email. Well, we can run this for you. We can do it virtually like we are right now. We can do it through Zoom. We can do it over the phone. We can send the report to you. What this will show you is where your tax gaps are. If you're paying too much in taxes, how to cut some taxes back. If you have opportunity to do a Roth conversion, if you have opportunity to take more money out and save on Medicare, which is a big one because there's a lot of jumps. I don't know if you can see at the bottom of the screen there, you see little lines going up there. That's called the Medicare jump. When you get to a certain level, your Medicare premiums go up. This is what the benefits of the complementary tax map software. I encourage you, it takes 15 to 20 minutes. And I'd say 80 to 90% of the people I've ran this for are taking more money out and saving more in taxes because now they know their situation. So the steps for you going forward, I mean, it's like taking off in space. You need that gas to take you off. You need that knowledge and that power to get you in there. If you don't do it, you're never going to get in orbit. You got to review your goals. You got to review your current situation. You got to take advantage if there's any available tax breaks right now, because I'm seeing Roth conversions like crazy. And talk to us about taking that next step. Is a Roth conversion correct for you? Is putting more money into tax-free beneficial to you? Is paying taxes now beneficial to you? How's your tax qualified accounts? What's going to happen in the market? And how is that going to affect you in taxes? And especially capital gains. If that capital gains tax shoots up, are you prepared for it? Do you have a backup plan? I encourage you, you can go to our calendly.com/DolphJanis. I have specific times set off for people in these webinars, anywhere from 15 minutes to an hour to talk with any questions to run that software for you. It'd be my pleasure. I said, if I can help anybody out, even if they don't become a client, karma, in my opinion, is going to come back and create a good thing down the road for us. So I encourage you, if you'd like to spend a few minutes talking. I know I'm talking a little fast right now because I get excited sometimes when I'm doing these presentations. I'm doing that. And also, we make all our resources available. Like I said, education first. Feel free to visit guardyoursavings.com. It's a complimentary page that will shoot you all the different services and resources we provide, and that could help you in your retirement processes going forward. We also have more webinars that we do almost every week right now. You can go to donotlosemoney.com to sign up for those webinars. This is where we learned all the information for. It's very important we cite this information because everything we talked about over the last 27 minutes came from these resources on the Joe Biden Tax Plan 2020, Gradient Financial, and from taxfoundation.org. This is where all this information came from. Again, the disclosure is I am not a CPA. I am not an attorney. I am a financial advisor. I am an income strategist here to present information to you to help you educate, to save yourself on taxes, because the best way to make money, folks, is not to lose money. Thank you so much for taking time out of your day and your afternoon to learn some more information about the proposed Biden tax structure. And I hope some of it helped. And I truly hope to get to talk to you sometime in the near future. Take care. Have a wonderful day and stay safe out there.